You know that feeling when you're trying to keep up with the stock market?
Hmm.
It can feel like, well, like you're drowning in information.
Absolutely. Earnings calls, expert opinions, global events, shifting things constantly.
And the big question is always, how do you make sense of it all? How do you actually make smarter investment decisions?
Hmm.
If you've ever thought, there has to be a better way, like a shortcut to cut through the noise and just get to what's important, then you're definitely in the right place.
Because that's pretty much exactly what we're doing here on the deep dive. You sent us this fascinating piece of research, and our job is to pull out the crucial insights.
The nuggets of knowledge.
Exactly. The things that can give you a real edge. Consider this your shortcut to, well, a deeper understanding.
And today, we're tackling a really innovative approach to predicting stock prices. It's something that looks beyond the usual, the financial statements and dives into some unexpected areas.
Yeah, this one's interesting.
You shared a paper with us titled Multimodal Stock Price Prediction. It's by Furkan Karadaş, Bahidin Arifçi, and Ahmet Murat Özbayolu from TOB University of Economics and Technology in Turkey.
And just the keywords tell a story, don't they? Financial forecasting, stock market, deep learning.
Finbird and ChatGPT. It signals we're right at the cutting edge here.
Absolutely. What makes this research so compelling, I think, is the fundamental idea that by bringing together different types of data, we might be able to forecast stock movements more effectively.
It's not just about the historical price charts anymore.
Not solely, no.
Right. So this deep dive is all about unpacking how combining these diverse information streams, things you might not immediately link to stock analysis, could lead to more accurate predictions.
We're talking about a potentially fresh perspective on the market.
And the paper reveals some pretty surprising connections between public sentiment and stock performance.
So let's set the stage a bit. The researchers start by highlighting just how complex and, frankly, fast-moving today's financial markets are.
Yeah, it feels relentless sometimes.
It's not just about a company's profits anymore. You've got global economies totally intertwined, political developments that can trigger, immediate market reactions.
And non-stop technological change.
Exactly. All playing a huge role.
Okay, let's unpack that. It feels like the sheer volume and speed of information can just overwhelm anyone, right? So relying only on traditional analysis, which often looks backward. It might be like trying to drive forward by only looking in the rearview mirror. You're missing a huge part of what's influencing things now.
That's a great analogy. The paper suggests traditional methods often struggle because they can't easily incorporate these dynamic, real-world factors.
Which is where this multimodal approach comes in.
Precisely.
Multimodal. So instead of just one way of looking at things, we're using multiple angles, like using different senses to understand something better.
That's a very insightful way to put it, actually.
So here, it's different kinds of data leading to a more complete prediction. Is that the idea?
That's basically it. In this context, multimodal stock price prediction means integrating various data sources beyond just the standard historical stock prices.
Okay.
And this particular study focuses on 3 key categories of information.
All right. Tell us about these different modes of data they looked at.
So first, they considered the traditional financial metrics, the kind of data you'd typically see. Historical price data, technical indicators.
Like RSI and moving averages.
Exactly. They specifically mentioned the Relative Strength Index, RSI, and the Simple Moving Average, SMA. Classic tools, really, for identifying trends and potential turning points.
Makes sense. That's the foundational layer. What's the second piece of the puzzle?
The second type of data is tweets from Twitter, or X.com as it is now.
Social media sentiment.
Right. What's really interesting here is the focus on these as a source of non-moderated real-time public opinion.
Non-moderated is key there.
But they didn't just look at every single tweet. They filtered them. They only looked at tweets with at least 100 likes.
Okay. So they were looking for tweets that actually had some level of resonance, capturing what was gaining traction, getting attention in the conversation.
Right, exactly. Focusing the signal, perhaps.
How much of this Twitter data did they actually analyze? It must have been huge.
Oh, it was substantial. Data collection ran from 2018 to 2024. For Walmart, they had 31,555 tweets.
Okay.
For Walt Disney.com, a massive 183,406 tweets.
Wow.
And for Microsoft, 53,446 tweets. So yeah, a truly significant pool of public sentiment.
It's a staggering amount of digital chatter. Okay, and what was the third data source they brought in?
The third component was news articles from the New York Times.
Okay, more traditional media.
Right. The researchers point out that these offer a contrast to the, often unfiltered nature of tweets. This is more moderated, expert-driven information.
Different flavor of text.
Same time frame, 2018 to 2024. And they collected, 2,930 articles for Walmart, 5,821 for Disney, and 3,629 for Microsoft.
So we've got the cold, hard numbers of stock prices, the sort of immediate, maybe reactive opinions on Twitter, and then the more considered analysis from a major news outlet.
A real mix.
Now, the big question is, how do you actually bring all of this together in a meaningful way? It sounds complicated.
Well, that's where the crucial step of capturing market sentiment comes in. They wanted to gauge the overall mood, by analyzing the text of both the tweets and the news articles.
And how did they do that? What tools did they use?
They used two different models for the sentiment analysis part.
Okay, lay this on us.
The first one is ChatGPT 4.0. Most people listening have probably heard of ChatGPT.
Oh, yeah.
This is the latest, very large-scale general language model. They gave it a specific set of instructions, a prompt, which is actually detailed in the paper's appendix if you want the nitty-gritty.
Okay, but what was the gist? What did they ask ChatGPT to do?
Essentially, they prompted it to act like a seasoned financial analyst.
Wow.
The prompt directed it to carefully evaluate the sentiment, positive, negative, neutral, in each piece of text, paying attention to things like financial performance mentions, stock price talk, the overall implications for the company's stock.
So not just happy or sad words.
No, definitely not. It had to assign that sentiment label and a probability score, like how confident it was, specifically within a financial context.
That context part seems really important. Understanding the financial implications. What was the other tool?
The second model was Finbert.
Finbert.
Yeah, this one's more specialized. Unlike the general-purpose ChatGPT, Finbert is specifically designed for analyzing financial text.
So it knows the jargon.
Exactly. It's a smaller model, but it's been trained on tons of financial documents, so it's really attuned to the language and nuances of the financial world.
Interesting. So ChatGPT 4.0 brings the broad language skills. Finbert brings the deep financial focus. Do they output scores in a similar way?
Yes, both models assigned a sentiment score from many a one, so highly negative.
Right.
Soft to +1, highly positive. And importantly, they also provided an accuracy percentage for each evaluation.
Which tells you how reliable that score might be.
Precisely. A high score with low accuracy, maybe not so useful.
Right. Okay. So the confidence level matters.
Yeah.
Now, the paper mentioned going beyond basic sentiment with the tweets. What did that involve?
Yes. This is where it gets really clever, I think. They incorporated engagement metrics.
Engagement. Like likes and retweets.
Exactly. Retweets, likes, comments, and the number of followers the user who tweeted had.
Okay, so the idea is that a positive tweet that gets shared a lot, maybe by someone influential, that probably reflects stronger positive sentiment than just one tweet that disappears into the ether.
That's the thinking. How much buzz did it generate?
How do they actually factor that in? Was it like a formula?
Yeah, they calculated what they called a weighted sentiment score. They gave a certain importance or weight to interactions, retweets, likes, comments, each got an initial weight of 0.3. User influence, based on follower count, got a weight of 0.1. Then, the actual sentiment score from Finbert or ChatGPT was adjusted by that accuracy percentage we talked about.
Wow, okay. So a highly engaged tweet with a confident sentiment score would have a bigger impact on the overall daily sentiment calculation.
Exactly. It's multifaceted. Not just the raw sentiment, but how much it resonates, who's saying it, and how sure the AI is about the sentiment itself.
That sounds like a much more nuanced way to gauge public opinion than just counting positive versus negative words.
Definitely more sophisticated.
Now, they had daily stock price data, but tweets and news come out all the time. How did they square that circle? Different time scales.
Yeah, that's a key methodological point. To align everything, they calculated the average daily sentiment score and the average daily accuracy percentage for all the tweets and news articles for a specific stock on a given day.
Averaging it out.
Right. And they also included the total count of tweets and news articles for that day. So this aggregated the text data to match the daily frequency of the stock price data.
That makes sense. You need that consistent time unit to analyze everything together.
Okay, so once they had all this harmonized data prices, sentiment scores, engagement stuff, what did they actually use to build the predictive model?
They employed a long short-term memory network, an LSTM.
LSTM. We've heard that term before. Neural networks.
Right. It's a type of neural network that's particularly good for time series data, like stock prices, because it has a kind of internal memory.
It remembers past patterns.
Sort of, yeah. Think of it like this. It doesn't just look at today's data point in isolation.
Hmm.
It can recognize patterns and dependencies across sequences of data over time.
Which seems crucial for something like stocks that evolve day by day.
Absolutely.
What were the specifics of their LSTM setup? Any interesting details there?
It was a fairly standard configuration, actually. Single layer, 256 units, rel activation, atom optimizer with a common learning rate, train in batches over 100 cycles. And the goal was just to predict the closing price for the next day.
Predict the daily closing stock prices, yes.
Okay. And how did they measure if this whole multimodal thing actually worked better? What were the metrics?
Right. Evaluation. They split their data, 2018 to 2022 for training the model,
Learning the patterns.
and then held back 2023 to test its predictions on new, unseen data. They mainly used two metrics, R squared.
Which tells you how well the predictions fit the actual prices.
Yeah, essentially how much of the price variation the model explains, and mean absolute error, or MAE.
How far off the predictions were on average.
Exactly. Lower MAE is better. And critically, they trained and tested separate models for Walmart, Disney, and Microsoft.
Because they're in different market situations, right? Neutral, bear, bull markets during the test period.
Precisely. And different capitalizations, different industries. You need to account for that.
Okay, let's get to the results. The core findings.
Mm.
What did they discover when they used Finbert for the sentiment analysis?
All right, looking at the Finbert results. For Walmart and Microsoft, the best performance, highest R squared, lowest MAE, generally came from combining the price data with those traditional technical indicators, RSI and SMA.
So the old tools still work well for them.
It seems so. R squared values were up around 0.92, 0.93 for Walmart, even higher for Microsoft, like 0.96 with those combos. So technical analysis still packs a punch for those two.
Interesting. So that suggests for these big, maybe more established companies, the traditional financial signals are still very strong. What about the Finbert sentiment data? Did it add anything?
It did, particularly for Walt Disney Co.
Okay. How so?
Well, interestingly for Disney, adding the weighted sentiment score of tweets actually improved the prediction performance compared to just using price data alone.
Right.
Yeah, the R squared went up, the MAE went down when they included that weighted social media sentiment.
Okay, so maybe a takeaway there is for companies with really strong consumer brands like Disney, where public perception is huge, that sentiment captured on social media could be a genuinely valuable signal.
That seems like a very reasonable interpretation. It connects with that idea of Disney living and dying by public perception, like you said. The digital water cooler matters.
What about Microsoft? Also a big name, lots of online discussion.
For Microsoft, the model that integrated everything, price data, tweets, news articles, and the technical indicators showed better results than just using price data.
So adding it all in helped there.
Yeah, again, R squared improved, MAE was lower with that broader data set. It suggests that even for a tech giant, bringing in these diverse information streams can enhance the predictive accuracy.
Okay, so overall, Finbert's analysis points towards sentiment data being a potentially valuable addition, especially for Disney, and maybe helpful in combination with other factors for Microsoft.
That sums it up well.
Now, how did things look when they swapped in ChatGPT 4.0 for the sentiment analysis? Similar patterns or different outcomes?
A bit of both, actually. For Walmart, the best results were still with RSI and SMA.
Okay, consistent there.
But they also found that adding tweet sentiment alongside those technical indicators did improve things compared to just price data alone. So a slight benefit.
But for Disney, you said Finbert showed improvement there. What about ChatGPT?
That's where it got quite different. With ChatGPT 4 analyzing sentiment for Disney, using only the historical price data was actually more effective than including the sentiment features.
Wow, really? That's the opposite finding.
It is. It's fascinating. You wonder, could it be that ChatGPT 4.0, being more general, maybe misses some specific financial nuances around entertainment stocks that the specialized Finbert picks up on?
That's a really interesting question. It really highlights that the tool you use for sentiment analysis can significantly change the outcome. What about Microsoft with ChatGPT 4.0?
For Microsoft, ChatGPT 4 also showed the strongest performance when combining the technical indicators with tweet sentiment data.
So that aligns with the Finbert results for Microsoft.
Yes, it suggests a pretty consistent benefit from incorporating social media sentiment for predicting Microsoft's stock, whichever sentiment model they used.
Okay, so across both approaches, technical indicators seem consistently strong. And sentiment data, especially from tweets, often chipped in positively. But the exact impact seems to depend on the stock and maybe the analysis tool itself.
That seems like a fair summary. It's not a magic bullet, but it adds something to the mix, often.
And to make this more concrete, they didn't just stop at R-squared values, right? They ran a market simulation.
Exactly. To see if this could actually translate into, practical trading decisions, a real-world application test.
Well, this is the so what part. How did the simulation work? What was the strategy?
They used a strategy where the model's predictions triggered buy or sell actions. Pretty straightforward. Predict a positive price change, signal a buy. Predict a negative change, trigger a sell.
Makes sense?
They also added specific conditions, like buying if the opening price dropped a lot compared to the predicted close, and selling if a 2% profit target was hit.
Okay, some risk management rules.
Yeah. They started with a hypothetical $1 million for each stock and ran the simulation through the test year 2023.
All right, let's hear the simulated returns. What did they find using Finbert's sentiment analysis in this trading scenario?
Okay, with Finbert. For Walmart, the highest simulated return came from combining price data and news articles. That yielded a gain of nearly 12.4%.
Interesting. News articles for Walmart. What about Disney?
For Disney, the top strategy, giving about 1.6% gain, specifically used that weighted tweet sentiment analysis we discussed.
Ah, so the tweets mattered most for Disney's simulated trading.
Seems so in this setup. And for Microsoft, the combination of tweets, news articles, and technical indicators produced a really substantial simulated profit over 42%.
Wow, over 42% for Microsoft in the simulation. That's huge. How did that compare to just using price data?
Significantly better. The price-only strategy simulation with Finbert for Microsoft yielded around 27.5%, according to their table. So adding the extra data layers really boosted the simulated performance there.
That's a dramatic difference.
Well,
What about the simulation using ChatGPT 4.0? Were the results in the same ballpark?
there were similarities and differences again. For Walmart, ChatGPT 4.0 also saw the highest gain with prices and news articles, though the percentage return was a bit lower than Finbert's.
Okay.
For Disney, weighted tweet sentiment didn't give the best returns with ChatGPT 4.0. Other combinations did slightly better, but honestly, the simulated gains for Disney were pretty modest with both models in 2023.
Right. And Microsoft with ChatGPT. Still strong.
Still strong, yes. The combo of tweets, news, and technicals performed well, but the simulated gain wasn't quite as high as the 42% plus seen with Finbert. Still significantly better than price alone, though.
So the market simulation really drives home the potential real-world impact, doesn't it? Incorporating these less traditional data sources, especially sentiment, might actually inform more effective trading strategies.
Precisely. I mean, the overarching implication here seems to be that looking beyond just the historical price numbers and actually trying to capture the voice of the market, the sentiment in social media and news, might give investors a genuine predictive edge.
Okay, so the key takeaway for you listening is probably this. Don't just focus on the numbers. This vast amount of text data out there, reflecting public and expert sentiment, seems to contain valuable information.
It could give you a more complete picture of market dynamics, yeah.
It could provide a richer context.
Exactly. And for you, someone keen on understanding how markets really work, this research underscores the potential value in considering these diverse data sources in your own analysis. Keeping an eye on the public conversation, expert opinions, alongside the usual metrics.
It might lead to a more holistic understanding.
That's the idea.
It definitely makes you think about where else you might find valuable signals, things traditional analysis might just miss. Now, the researchers mentioned future plans, right? What's next for them?
Yeah, they're aiming to refine their models further by adding another layer, macroeconomic indicators.
Oh, like GDP, inflation.
Exactly. GDP growth rates, inflation figures, unemployment data, adding that broader economic context to their multimodal approach.
That makes perfect sense. Those big picture economic factors obviously play a huge role in overall market behavior.
Excellently.
It really makes you wonder what other unconventional data sources might hold useful insights. Maybe things like, internet search trends for products, or even satellite imagery tracking retail foot traffic.
That's precisely the kind of innovative thinking this research sparks, isn't it? It opens up this whole landscape of possibilities for using less conventional data to get deeper insights into the, let's face it, incredibly complex world of financial markets.
Certainly a field that seems ripe for more exploration.
Absolutely. Lots more to potentially uncover there.